Most people think a debt crisis begins with panic. It does not. It begins when the numbers stop healing on their own, but the headlines still look calm. It begins when borrowing no longer buys time and starts eating the future instead. By the time the crowd sees it, the spiral has already been turning for a while. If you like hearing the pattern before it becomes a headline, stay with me, because this is one of those moments when paying close attention can save people years of pain. I have spent a lifetime studying how countries rise, how they overborrow, and how they deal with the point when promises become too large to honor in the normal way. What worries me now is not one dramatic event. What worries me is that the mechanism has already started, and most people are still looking for a single loud crash instead of the quiet math that comes first. When I say debt spiral, I am not trying to be dramatic. I am describing a process. It is the point in the cycle when a borrower has so much debt that part of the new borrowing is used to service the old debt, and then that burden grows faster than income grows. In simple terms, you are no longer borrowing to build. You are borrowing to keep the machine from choking on what it already owes. That is why so many people read this situation the wrong way. They think a debt problem means the United States suddenly cannot pay its bills like a household that ran out of cash. That is not how this works for a country that prints the world's main reserve currency. A reserve currency is the money the world uses most for trade, savings, and global finance. The danger is usually not that the check bounces. The danger is that the value of the money gets weakened, the interest bill climbs, and the bond market starts demanding terms that hurt everyone. Right now, the numbers are telling a very clear story. Total U.S. federal debt is now close to $39 trillion. Debt held by the public, which is the part owned by investors and institutions outside the government itself, is above $31 trillion. The annual deficit has been running near $1.9 trillion. That means the government is spending far more than it collects year after year, even before the next recession arrives. Now think about what happens when interest rates are no longer near zero. For years, cheap money acted like pain medicine. It allowed governments, companies, and households to refinance old debt at very low cost. That era is gone. As old low-rate debt matures and gets replaced with new debt at higher rates, the interest bill rises almost automatically. It is like a long fuse. People do not notice it at first, and then one day they realize the floor is already warm. That is exactly why I say the spiral has started already. Interest costs are now around $1 trillion a year, and they are becoming one of the biggest items in the entire federal budget. Think about what that means in real life. It means a larger share of tax revenue is not going to roads, defense, research, education, or anything new. It is going to service the past. When a country reaches that stage, the future starts getting crowded out by old promises. Ask yourself one hard question. How much of your own financial plan assumes the system will simply grow fast enough to make this burden disappear? That assumption is doing a lot of work in a lot of portfolios. I have learned to be very careful when most people are counting on growth alone to solve a debt problem, because history usually asks for something more painful than that. The next mistake people make is thinking the debt only matters if there is a recession. The debt matters even in a decent economy because the base level of borrowing is already too high. In early 2025, the U.S. gross debt stood near $36.2 trillion, with about $28.8 trillion held by the public. Even at that point, I warned that the deficit needed to come down from roughly 7.5% of GDP to around 3%. GDP is the size of the economy. So when I say 3% of GDP, I mean the deficit has to get much smaller compared with the income of the whole country. Why 3%? Because at that range, if growth is reasonable and rates are not too high, the debt burden has a chance to stabilize instead of accelerating. But if you sit near 6, 7, or 8% deficits in normal times, you are not running an emergency budget. You are hardwiring future stress into the system. Then when a downturn comes, you have less room to respond. That is when the bond market starts watching you the way a doctor watches a patient whose condition keeps getting worse, but who still refuses to change his habits. I want to slow this down because the mechanism matters more than the slogan. A debt spiral usually moves through a few steps. First, debt grows faster than income. Then interest costs climb because rates rise or because there is simply more debt to service or both. Then the borrower has to issue even more debt. Then buyers start asking whether they are being paid enough for the risk. If they demand higher yields, the interest burden grows again. That feedback loop is the spiral. A yield is just the return investors get for holding a bond. When yields rise, borrowing gets more expensive. So if the government has to keep selling huge amounts of bonds into the market and buyers become less eager, it has to offer better terms. Better terms for the buyer mean worse terms for the borrower. That difference is where the squeeze begins. It does not look dramatic at first. It looks technical. That is exactly why most people miss it. I have watched many cycles where the late stage feels strangely normal. Stocks can still rise. Employment can still look okay. Politicians can still act as if there is no urgent problem. The reason is simple. Markets often reward the early part of debt creation because it supports spending and asset prices. The damage comes later when the volume of debt becomes too large and the cost of carrying it starts to dominate the benefits. If this is making you rethink what safe really means, keep listening closely because this is where the story gets more personal. Most families understand the danger of paying one credit card with another. Most business owners understand the danger of borrowing more just to cover old interest costs. Yet when a country does a version of the same thing, many people assume it is fine because the numbers are larger and the language sounds more official. Scale can hide weakness. It does not remove it. There is another reason the spiral is harder to see now. The United States still has enormous strengths. It has deep capital markets. It has military power. It has innovation. It has the dollar. Those strengths are real and they buy time. But the very fact that they buy time can become dangerous because it allows policymakers to postpone discipline far longer than a weaker country could. The reserve currency privilege is powerful, but if you abuse any privilege long enough, the behavior that once looked like freedom starts to look like dependence. I also pay close attention to who is buying the debt and who is quietly diversifying away from it. Foreign investors still hold more than $9 trillion of U.S. treasuries. Japan remains the largest foreign holder at around $1.2 trillion. China is still large, but its holdings are far below the old peaks and sit closer to 700 billion. That matters because it tells me the world is not running from treasuries all at once, but it is not leaning into them with the same confidence either. That shift is subtle, and subtle things often matter most. Foreign official institutions, which include central banks and governments, hold under $4 trillion of treasuries. At the same time, central banks have been buying gold at a very strong pace. In 2024 alone, they added about 1,045 tons of gold, marking a third straight year above 1,000 tons. I do not see that as a random trade. I see it as a signal that more countries want reserve assets with less political and currency risk attached to them. Gold does not replace the dollar tomorrow. That is not the point. The point is that when central banks choose to diversify, they are telling you something about trust, optionality, and long-term insurance. Optionality means keeping choices open. If countries feel the world is becoming more fragmented and if debt burdens keep rising, they naturally want part of their reserves in an asset that is nobody else's liability. That is how institutions behave when they sense the system is getting more fragile. I also look at the Federal Reserve because people often assume it can rescue the situation the way it did before. The Fed still holds trillions of dollars of treasuries, roughly 4.5 trillion, but unlike the crisis years when it was expanding its balance sheet aggressively, it has also been trying at times to step back and let the market absorb more debt. That changes the balance. If the Fed is not the giant buyer, then private investors have to absorb more issuance, and they will do that only at yields they find attractive. Here is the skeptical objection I hear most often, and I want to treat it fairly because it contains a piece of truth. People say the United States can never have a debt crisis because it borrows in its own currency. I agree with the narrow point. The United States is very unlikely to face a classic hard default in the way an emerging market might. But that is not the only kind of crisis that matters. If you print money to ease the burden, you can pay in nominal terms while still damaging holders through inflation and currency weakness. Nominal means the number printed on the bill. Real value is what that bill can actually buy. That difference is everything. A government does not need to miss a payment to hurt savers. It only needs to return dollars that buy much less than the dollars people lent. That is why I focus so much on the bond market. A bond market heart attack does not have to mean the government cannot issue debt at all. It can mean investors demand much higher yields, financing costs jump, other assets reprice, and policymakers are forced into choices they would never make voluntarily under calmer conditions. What does that look like in daily life? It can mean mortgage rates stay higher than people expect. It can mean business investment slows because the cost of capital stays elevated. Cost of capital is just the price of getting money to build or expand. It can mean the stock market becomes more fragile because future earnings are discounted at higher rates. It can mean the government finds itself spending more on interest than on many functions citizens assume come first. And this is happening inside a political system that is poorly built for restraint. Aging populations push up health and retirement costs. Defense demands do not go away in a more dangerous world. Voters want lower taxes and more benefits at the same time. Politicians are rewarded for promising relief now and pushing the bill into the future. So when I say the problem is deeply political, I do not mean that as a slogan. I mean the math is obvious, but the incentives are upside down. Would you want your life savings tied only to long-term promises in a currency that may be one of the main release valves for this pressure? That is not a question people ask often enough. Most people spend more time comparing one stock to another than thinking about the quality of the unit they are saving in. But when debt burdens get very large, the unit itself becomes part of the story. History helps here not because it repeats in a perfect way, but because it rhymes in very useful ways. After World War II, U.S. federal debt was more than 100% of GDP, around 106% in 1946. By 1974, that ratio had fallen to roughly 23%. Many people tell that story as if the country simply grew out of it. Growth helped, yes, but so did financial repression, controlled rates, and inflation. Financial repression means policies that keep interest rates below inflation and push savers into government debt, allowing the debt burden to shrink in real terms. That kind of adjustment does not feel like a default, but for savers, it can still feel like one. If inflation runs higher, then the return on your safe assets, your purchasing power is being slowly transferred. You see dollars in your account, but those dollars buy less. I learned a long time ago that governments facing extreme debt burdens usually choose some mix of austerity, restructuring, money printing, and below market real returns. They rarely choose one clean path. They usually choose a messy combination. The 1970s offer another lesson. In 1971, the dollar's link to gold was broken, and the system moved into a more flexible fiat era. Fiat money is money backed by government order, not by a hard asset like gold. That gave policymakers more room to respond to stress, but it also made currency debasement easier. Debasement simply means reducing the value of money over time. Again, the issue was not whether the government could pay. The issue was what the value of the payment would be. Now widen the lens beyond America. Global debt reached roughly $251 trillion in the latest IMF data, and that sits above 235% of world GDP. Public debt alone is near 99 trillion. So this is not just an American story. It is a world saturated with debt, aging populations, political friction, and slower trend growth. When many major countries are over indebted at the same time, the system has fewer clean escape routes. Not everyone can export weakness at once. Not everyone can devalue against everyone else. That is why geopolitics matters here too. A more divided world makes capital less trusting and more selective. Sanctions, trade blocs, military tensions, and industrial policy all push countries to think harder about financial exposure. If a government sees reserve assets as potential tools of pressure, it becomes more likely to diversify those reserves. That does not end the dollar system overnight, but it does chip away at the passive demand that once made U.S. borrowing easier. If you want me to keep mapping these shifts the way I study them, stay close, because the important part is not just spotting the problem. It is understanding the range of ways it can unfold. I do not think in certainties. I think in probabilities, and I try to build around them. That mindset matters now more than ever. So what could happen next? I see three broad paths. The first is the most constructive. Productivity rises, maybe with help from technology. Growth stays decent, deficits come down, and the debt burden stabilizes gradually. That path is possible, but it requires more political discipline than I currently see, and it requires growth strong enough to offset costs that are already deeply embedded. The second path is the quiet inflation path. In that case, the system avoids a dramatic blowup, but the burden is reduced by keeping real returns on savings too low for too long. Nominal rates may look okay, but inflation stays high enough or bursts back often enough that cash and long-duration bonds lose buying power. Duration just means how sensitive a bond is to changes in interest rates. Longer duration assets suffer more when rates rise or inflation stays stubborn. This path is politically easier because it feels less like open austerity, but savers still pay. The third path is the sharper market stress path. In that version, the bond market loses patience faster. Treasury auctions grow more difficult. Yields move up enough to tighten financial conditions hard. Other asset prices fall. Growth slows or contracts. Then policymakers face ugly choices between recession, financial repression, monetization, or some forced mix of all three. Monetization means the central bank effectively helps finance government debt creation. It can stabilize the market in the short run, but it can weaken trust in the currency over time. Most people want me to say which path I know will happen. I do not operate that way. The world is a machine with many moving parts, and the smart approach is not to insist on one exact prediction. The smart approach is to understand the mechanics, assign probabilities, and position so you can live through more than one outcome. That is how I have always tried to invest, and it is how I think people should think now. What does positioning mean in plain English? It means not being concentrated in one story. It means not assuming cash is always safe in real terms. It means not assuming long-term bonds are harmless just because they look official. It means owning a mix of assets that can survive different environments, including inflation shocks, growth slowdowns, and periods of policy intervention. In my own thinking, balance matters more late in the cycle than brilliance. Would your portfolio still make sense if the next 10 years are not a clean repeat of the last 10? That is the question I would sit with. A lot of people built habits during a period when rates fell, liquidity was abundant, and each scare was eventually met with support. That environment shaped expectations. But cycles turn, and when the turning point comes, old habits can become hidden risks. I am not saying the United States is finished. I am not saying the dollar disappears. I am not saying there is no way out. I am saying the debt spiral is not some future monster waiting in the woods. It is a process that has already begun in the arithmetic, in the refinancing, in the interest burden, in the politics, and in the behavior of institutions that are quietly adjusting. Once you see that, you stop waiting for the movie version of the crisis and start paying attention to the slow motion version that changes real wealth. That is the part I most want people to understand. The early stage of a debt spiral can coexist with strong markets, patriotic language, and public denial. It can even coexist with optimism, but optimism does not cancel compounding. Math compounds, interest compounds, incentives compound, delays compound. And when those forces run for long enough, they force a repricing of what people thought was stable. So I come back to the same calm conclusion. The issue is not whether the system will ring a bell for us. It will not. The issue is whether we recognize the pattern before the adjustment gets chosen for us by the market. If the deficit does not move meaningfully lower, if debt keeps compounding faster than income, and if buyers become less automatic, then the path of least resistance will likely be some mix of tighter money, weaker real returns, and currency debasement. I have seen enough cycles to know that most danger arrives wearing ordinary clothes. It looks manageable. It sounds technical. It gets explained away. Then slowly at first and then all at once, people realize they were not watching a warning. They were watching the beginning. Debt does not destroy a nation in one loud moment. It does it by making the future pay for the past until even strength starts to feel expensive. That is why I believe this spiral has already started. And when a country has to borrow to carry yesterday, tomorrow is no longer an asset.